This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, global leaders are freaking out in response to China's latest move. We'll show you what Beijing just did and why governments all around the world are outright terrified. But I need to understand what's going on inside China's economy, and to do that, let's head over to Bloomberg, where we picked today's story up with a headline. It's China's factory activity shrinks in surprise hit to growth outlook. And so this is something that was unexpected, because we're supposed to see a revival in the global economy, and China is one of the countries where we should see the beginning of that. And in response to the slowdown that's now happening there, well, Beijing's doing the unexpected. As the official manufacturing purchasers manager index fell to 49.5 in May, that compares with a reading of 50.4 in April. Now at 50, it means virtually unchanged from the month before, but now we're starting to see that next downward move in China, as we see under 50 denotes a contraction. A reversal in manufacturing after 2 months of gains flags a threat to China's economic growth target of around 5% this year, which is really about a fantasy at best. The country's export-oriented industries are expected to play the crucial role in hitting that goal, with consumption at home still weighed down by a real estate slump. And you're starting to see the problems that are going on inside of China. Their manufacturing base, which powers their economy, drives their housing market, drives domestic consumption, is struggling. And on the reason why, it's very simple: because the rest of the world is slowing down, heading into recession, and demand is waning. And this is a big problem for China, which is forcing Beijing to do something that other governments don't want them to do. As China's exports posted solid growth in the first 4 months of the year, and we know that was largely driven by U.S. consumers, of course, tapping out to the red line, their credit cards, and then turning to those for-pay things called buy now, pay later to drive consumption. But now that those are tapped out too, well, demand is going away along with demand for Chinese goods. But the PMI sub-index for new export orders contracted in May for the first time in 3 months. A measure of input prices climbed to the highest in 8 months, reflecting rising commodity costs. So you have a big problem in China that we're seeing in other countries. Demand is going down, but costs are rising. Of course, that is going to actually cause a major problem in the economies. When we usually see that happens, what's next to follow? Well, is recession, as demand goes away. And sure enough, we can see the demand for Chinese goods goes down. If we look at overall imports into the U.S., shown as goods and services in red, against advanced retail sales. And what you can note is, as retail sales in blue slows down, what do you start to see? Well, imports coming into the country, well, they slow down and contract. And we're seeing that now. There was a kind of a push in the first quarter to drive imports. It looked like, hopefully, demand was turning around in the U.S., but what we just found out, based on what the retail sales data is suggesting, and what a lot of earnings reports are telling us, is demand from U.S. consumers is plummeting in a very rapid manner. And that's bad news for the second largest economy. Even their services sector activity in construction and services came in at 51.1, suggesting a slight expansion, comparing with, of course, April's reading of 51.2, suggesting that they're really sitting in stall speed when it comes to their economy. And this is going to wreak havoc around the world, which is why Beijing's making a very critical move here, something that world leaders don't like. But something you should like is when you see headlines like this when you wake up, because if you put a trade on wheat, you want to love that it's jumped the most since the war in Ukraine due to weather swings. This from today, and you're wondering, how did you take advantage of that? Well, our subscribers did. Here you can see our CTA Time Pro knocked down as of close of business yesterday, over 22% return. Our Momentum Time Pro flagged this trade twice at 21 and almost 20% return back in March, and that meant you were buying down here. This is what our subscribers did. We told them this is where you want to be buying, and now they're watching the price of wheat go higher, and when they see those headlines, they're smiling in a big way. And how is it they're doing it with such relative ease? Well, we take a look every day at the machine positioning, and we know note, when the machines are in deep short position and price rallies against them, that means they've got a short cover. We give you the early alert because we do something the machines don't do. That's run a historical overlay. We give you the report. We give you a video on how to actually interpret the signals and trade them. And maybe you're a technical trader. You like those things like the RSI and the MACD, but you find yourself getting in late and out early and all over the place. We have a report on that, which gives you high value momentum signals because we run a proprietary overlay. We give you the videos, we give you the signals, and we help you do something other people can't do, and that is give you high success rate trades that turn out some really big numbers. And here's the best part. You can jump on a 30-day free trial. We'd love you to try it out. Link in the description below, because President Xi Jinping pledges to make youth employment a top policy priority. So I want you to see that the manufacturing sector in China is starting to roll over, and we suggested in previous shows that when the global economy got past that recent rally, as it started to turn lower, it was going to cause a lot of problems. Well, in China, the problems are even deeper than that, and it has everything to do with the fact they've got a large idle workforce. As full employment should become a priority goal for social and economic development, while employment for college graduates should be the focus of the focus, she said at a recent study session. The comments come as young people have struggled to find jobs in China amid an economic slowdown. She has previously instructed them to learn to, quote, eat bitterness, using a colloquial expression that means to endure hardships, as he suggests that there are no other alternatives. Could you only imagine if our president came out and said, well, you need to eat bitterness? I don't think that would go over very well. But one of the problems in a country like China is when you have a large number of people that have nothing better to do, well, it generally does not bode well for those who are in power in their government at all, as almost 11.8 million graduates will enter Chinese job market this year, up 2% from last year. Meanwhile, unemployment between 16 to 24-year-olds hit a record high last summer before Beijing just changed its counting method to exclude them, which then it said reflected a more accurate picture of unemployment because, well, the best way to fix unemployment is to actually exclude people that would be counted. So what I want you to see here is the manufacturing sector is ailing. The services sector isn't driving enough consumption, and they have a large able-bodied workforce that has nothing else to do, and even more of them coming into the workforce. This is putting Beijing in a situation to do something, of course, that the rest of the world doesn't want them to do. But one of the biggest drivers of China's economy is housing. Well, and it's not looking good either, as China's mega cities loosen home buying rules as age spreads. So if you think the property sector was going to drive jobs, well, Beijing's hoping, and it's not working, as officials are trying to revive homebuyer confidence has been crushed by falling prices, unfinished apartments, and job insecurity. The latest easing comes after the government unveiled a package earlier this month to unleash 300 billion yuan of funding to help local authorities, get this, buy unsold homes. So again, you have a weakening manufacturing sector, you have a large amount of young unemployed people, and you have a bunch of empty properties. So the government response is, well, maybe if we buy them all up and take them off the market, that will revive the housing market, maybe spur demand. Well, it just didn't work, because reviving sentiment is a daunting challenge, particularly when people don't have jobs. And there was a flurry of activity among homebuyers after the central government announced this rescue package earlier this month, but it's already begun losing steam, and that is expected because those who have jobs are seeing demand go down. And the problem in the real estate sector is they've got a lot of empty homes. As China's 60 million homes are hard to sell, even in big cities. Check this out. The country has the equivalent of 60 million unsold apartments. Could you imagine that? Which will take more than 4 years to sell without government aid. The oversupply is dragging down prices at the fastest rate in a decade, giving people less reason to buy a home. The situation, of course, being now worse in the capital city. So if you think about this, if you're trying to get people to buy these homes and drive consumption, the challenge is they don't have jobs, and there's no outlook where they're going to have jobs. Big problem, of course, for Beijing, but that problem is about to be everyone else's, as there's no guarantee that the loosening will revive home sales immediately. As I've suggested, we need the global economy to turn around for that to work, as homeowners, even in big metropolitan areas, are losing conviction in their decades-long belief that property is a reliable store of wealth. So in China, they turn to the property market to save their money. In the U.S., of course, upsets the equity markets. When the Chinese property market continues to go down, what's going to happen is people are going to sell and want to get out. That's going to drive prices down even more. The same thing will eventually happen in the equity markets here when people realize that they don't go up forever and they start to sell. When we enter a proper bear market, you're going to watch a mass exodus, and that means China's got to do a move that global leaders don't want them to, and that is, well, let their currency continue to fall, because it means jobs in other countries are about to go away. As yuan weakens to the lowest since November, China is allowing declines. Remember, they were trying to put a stop to it. Now they're just letting it slide as the PBOC faces a constant battle to find the optimal pace of yuan weakness that's conducive for growth without triggering market panic or capital outflows. And what they're really trying to do here is transfer jobs from other parts of the world into China. Remember, they've got this big manufacturing base. They've got a huge workforce, which I've shown you. They've got a lot of homes for those workers to buy. They just don't have any work for them to do. But the best place to do that is to take it from those who have it. And how do you do that in a global economy? Well, you gradually let your currency continue to weaken day after day over time until, of course, producers and their demand from other countries starts to turn to yours, because the cost of manufacture there are far less. It's a really slick move, one that global leaders are not excited about, as yuan is not alone in struggling with depreciation pressures in Asia, as the currency of his neighboring country, Japan, just hit the lowest since 2008 against the pound. The likes of the Thai baht and Indonesian rupee are also close to multi-year lows, and that is bad news, because that suggests that what we could see is an all-out currency crisis, as the Fed won't be slashing rates anytime soon due to surprisingly resilient growth. Well, that's going to change, and sticky inflation that isn't as sticky as most people hope. So China's goal here, take jobs away from other countries. The problem here that global leaders have is one that's going to take jobs away from what they need in their country to keep their economies going. At the same time, it risks currency crisis in other currencies all around. China, dangerous game to play, and we can see demand is getting worse as China's oil demand outlook darkens as OPEC Plus prepares to meet. As we see, of course, the group has curbed oil supplies to stave off a surplus and shore prices, and is expected to continue the measures into the second half of the year. But a downturn in Asia's biggest importer could derail its efforts, and there again, there's no sign right now that there's any revival in China's economy, which means oil prices are likely to head lower, and that means, of course, OPEC is going to have to make another move. As crude prices have retreated to almost $10 a barrel in the past 6 weeks, as China's darkening outlook adds to downward pressure to a global market awash with plentiful supplies from the U.S. and elsewhere. Meanwhile, there's only certain investors that are super bullish on energy. That remains U.S. retail investors. They believe that any conflict sends the price higher, but deep inside these other countries, we're finding out inventory levels are high and rising. And you can see, of course, where crude oil prices go has everything to do with demand. Here we're looking at advanced retail sales in blue against West Texas Intermediate, that both shown on a year-over-year rate of change. And you can see where retail sales go. And this is very key. So we talk about China's economy and how its exports are weakening. Well, that means crude oil prices also likely now to head lower, despite the fact that U.S. investors remain bullish on oil at a time when OPEC likely to make a big move here. As the heart of weakening demand is China, but really it's coming from all over the rest of the world. If these early indicators of an emerging imbalance in China last, then OPEC Plus would feel pressure to roll over its supply cuts, which is a huge problem, because we've talked about how high energy prices are eating into U.S. consumers' budgets, keeping them from spending money on the discretionary side of the economy, which is forcing the hand and causing the U.S. economy to slow. And I've noted this happens in the past, and we've discussed this about how OPEC will tighten supplies to try to drive oil prices higher as the global economy slows. And what they really end up doing is exacerbate the situation and drive the global economy into a recession. They do this every time. And in the U.S., the world's biggest oil consumer, crude inventories at a storage hub in Cushing, Oklahoma, are now at the highest level since July. As gasoline demand, while set for a boost when Americans take to the roads for vacation this summer, remains below the same period last year, implied consumption figures show. So we're very keen to watch, of course, demand from crude oil and gasoline in the weeks and months to come, because based on what we saw last week, data, what we just got on Wednesday, is that demand for crude oil and gasoline is weakening here in the U.S. It's telling us consumers are financially tapped out, and that's not good, because OPEC says they're likely to continue to keep their output cut stretched into 2025 as they keep trying to push prices higher. The reason why? Well, they've got bills too, but I want you to see that higher energy prices against weakening consumption tells us the inevitable is about to happen, and this is the time. Of course, we know that global leaders, they're worried about what China is doing, because they're going to drive their currency down, take jobs away from other countries, and risk all-out currency crisis in other peripheral countries around them. It's a dangerous game they're playing. Here we can see advanced retail sales. Now we're looking at crude oil, but instead of a year-over-year rate of change, we're looking at dollars per barrel. And I want you to see is when you see a slowdown in retail sales, you'll note that there's times where crude oil prices is rallying against a weak economy, and all that does is exacerbate the weakness and drive down demand, leads to higher unemployment, weaker sales, and ultimately heads us into a recession. That's the path we're on now, and we can all just look to China as a leading indicator of where the world is headed. And now it makes perfect sense why global leaders are so unhappy that China is letting the yuan go down. Well, they have no choice. Their economy is in a dangerous situation and on the brink of total collapse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.